Treasury Secretary Janet Yellen is warning that the nation could see the first ever U.S. default if there's no deal to raise the borrowing limit by October 18th. So for more on what this all means, the market, what's happening in Congress, let's bring in CBS News business analyst Jill Schlesinger to talk about all of this and to break it down for us. So, Jill, it's good to see you. Break down exactly what the debt ceiling means and how government spending is actually at issue here. I know a lot of people try to liken it to a credit card and your credit limit, but it's not really like that, is it?
Well, it's a little bit of weird wrinkle of history. And this debt ceiling goes back 100 years, actually, when we were talking about the financing of World War I. And essentially, there was this idea that we needed to give Congress a little bit more flexibility in the spending of money and in ways to pay back the money that we have committed already. So fast forward 100 some years. And what this means is that there is actually a statutory limit on the amount of debt that can be outstanding unless Congress raises it. Now, Congress has raised the debt ceiling almost 80 times since 1960. It's a fairly routine matter because it's a little bit of an old, clumsy vehicle. But what you really need to know about the debt ceiling is this is not about new borrowing. This is about paying the bill for a commitment that we have already made, that presidents and Congresses in the past have made, and now we need to pay the bill. The reason why you hear the credit card analogy is because it's as if, Vlad, you and I had decided we're going to go out and buy a flat screen TV. We go buy it. We put the purchase on a credit card, and then eventually we have to pay the credit card bill. So the analogy, if you bring it forward, is, hey, Congress, you decided to have tax cuts in 2017. You decided to do COVID relief in 2020 and 2021. We decided as a country we want Social Security and Medicare and military paid for. Now we've got to pay for it. Well, we don't have enough cash on hand to pay for it, so we need to actually increase the amount of debt that we can use to pay those bills.
Do you know Denmark is the only other country that has a debt ceiling, but they never come to sort of the edge of the cliff the way we do because they have a parliamentary system there with many different parties, so they are forced to negotiate.
Yes.
So here we are at an impasse. The Republicans say, listen, it's up to the Democrats to raise the debt ceiling. They're not interested in doing it. That was so last administration. They're taking a break, so they say right now. But the real question is, and I'm sort of a little tongue-in-cheek because sometimes, you listen to all that wrangling, all the arguments, and you know, a little bit of a dog and pony show in Congress, and really all people want to know is, well, how does this affect me? So that is my question to you. How could an impasse in Congress be an issue for regular people like Vlad and myself?
Right. So, and I think all of us really want to understand that. So the problem with not raising the debt ceiling means that we as a country might not be able to pay back obligations that we have made. So what do I mean by that? It means that we might miss bond payments that are due. And just the mere whiff of that could actually cause financial markets to tumble. We could also see potentially the markets drive us into a second recession in, just a year and a half. And the real issue that we would see around that is that nobody wants another recession. Nobody wants more job losses. Nobody wants to see financial markets in turmoil. While these may all be short-lived, there is real human cost to it. And I think that that's the thing to remember. Back a decade ago, when Anne Marie was still in high school, not worrying about such things, Vlad and I were watching. Vlad and I were watching the debt ceiling go to the very edge. This was in August of 2011. And we did not miss a bond payment. We came close, and just coming close caused a ratings agency to downgrade the rating of U.S. government debt for the first time ever. This caused stock markets to drop by 14% over 4 weeks, bond markets to go crazy, and the world to think that the United States is a bunch of nutbags when it comes to managing their fiscal lives. And one of the things that I think is really important here when we talk about the cost to us, I don't think that people would panic and sell at the bottom. But generally, if we saw interest rates rise, that would mean the cost of all the things that we need mortgages, car loans, student loans, cost of borrowing could rise. And I think that that is something that does impact everyday Americans. So with all the hoopla in Washington, D.C., and as you said, Anne-Marie, the grandstanding, there is a potential impact on our lives that is real.
So speaking of the potential impact on our lives, Jill, I'm sure that there are people wondering, well, what does this mean for me? And I think that generally when people are following along with the news cycle, they generally mean, what does it mean for me in the short term? And as I know that you like to educate our audience and folks that listen to your podcast, you should be thinking about things with a longer term perspective, and the gyrations of the stock market today or last week or even over the next couple of months should not affect what your plan is for retirement or to put away for your kids' education or for any kind of long-term planning that you're potentially holding out for.
Absolutely. I think what's fascinating to me about these moments is that I am a bit of a historical nerd. So I did like to learn about the origins of the debt ceiling. But when you drill down into our everyday lives, the gyrations should not derail you. But I will say something that's interesting that's going on in the economy right now. And we saw it in, as you mentioned, September being the first down month for the stock market. It was ended up the quarter okay. But I want to also be clear that long term, saving and investing for your future makes a ton of sense. But there is a really interesting inflection point going on right now. And that is that we've been in this ultra low rate interest rate environment. That has meant that the Federal Reserve has kept interest rates down at 0 to 0.25% since the pandemic. So these emergency measures are going to start to shift. The Federal Reserve has also told us that it is going to stop buying as many bonds. They're going to taper their purchase of bonds. That was also an emergency measure. Now, what does that mean for you? I take that as a real clue that many people who are worried about what's going on in their financial lives should be paying attention to this shift. So it's going to mean there's going to be better news for savers. Savers are going to earn more interest on their money. Borrowers, you are not going to see sub 3% 30-year fixed rate mortgages forever. In fact, they just went to 3% yesterday. So I want to be clear that there are shifts that are occurring, and the things that you should be doing to take advantage of that might include, hey, I've been sitting on the sidelines waiting to refinance. Maybe I should refinance. Hey, you know what? I was looking for a house, but the cost of a home is really expensive. I really should run those numbers of the rent versus buy. And you know what? Hey, I'm not putting enough money into my retirement account. And if I do that slowly but surely, I can build up my nest egg. The most important thing that you can do is create some sort of game plan, stick to that game plan. Don't let events derail you from what you really want in the future. And I know it's hard not to get caught up in the news cycle. I know it's hard for emotions that feel like very strong that you want to get in or get out at a particular time. But if you actually go back to your plan, then you can say, oh, wait, I know what I'm trying to do. That's my recommendation.
Jill, as per usual, solid advice. Thank you very much.
Thanks for having me.